Welcome back to Money Movers, live from the Milken Conference here in Beverly Hills. Our next guest firm is one of the largest credit-focused asset managers, $70 billion in assets under management. Joining me now in a CNBC exclusive is GoldenTree Asset Management founder and CIO, Stephen Tananbaum. Welcome, Steve. Good to see you.
It's great to see you, Sarah. It's great to be here.
Yeah, and it's great to talk to you right now, especially. We don't hear from you that much because I have been curious how you do public credit, private credit.
Yep, the whole gamut.
The whole gamut. So how you're viewing what's happening now in private credit. I don't think anybody here is saying that it's systemic, but
Yep.
I do wonder how much longer this shakeout goes and how severe it gets. What do you think?
So I think on private credit, it's more of a vintage issue where you had a lot of money coming into one subsector of credit, and it turned out that that subsector, because it had so much money, financed cheaper than other subsectors. So the value wasn't great. We're seeing good opportunities in private credit. As a result, it's a vintage thing. My guess is the funds and the investment period broadly from 22, 23 won't be as good as the vintages before. And my guess is, at least right now, we're seeing some good opportunities. And some of the anxious money that was, an anxious meaning had to be put to work. And there was a small subset open BDCs. So those
Retail funds.
Yeah, the retail funds, but think of them as mutual funds. And some of these funds are getting 10 to 15% each quarter. So you're talking about maybe 60% a year that if you don't put to work, you're going to dilute the other holders. And that's slowing down. My guess is there's going to be some sort of change in terms of once these funds are at a full size. My guess is there's going to be a difference in how they collect or what they take in per quarter.
They'll be more risk averse?
No, I think they'll just be more deliberate.
Okay.
My guess is, after this episode, more deliberate about the amount of capital that they take in.
When you say you see opportunities now in private credit, what do you mean?
So
what are we
it's there's always the certainty of closing and what you're going to pay for that. And the certainty of closing, because of some of the flow issues, we're getting paid a higher yield, particularly if they're transactions, than what we were a few months ago. Now, to put this in a scale of 1 to 10, if 10 is really good and 1 is really poor, we went from like a 4 to a 7. We're not talking about the opportunities are fine,
right,
but I wouldn't call them special.
Screaming.
Yeah.
I mean, a lot of this started with, the investors worrying about software,
Yes,
right, and disruption from AI.
Yes.
And that was such a hot space for this private lending. And I'm curious how much exposure you have there and what you're doing on that front and looking at your portfolio and thinking about who's vulnerable.
So there's a good bull and a good bear argument in software. It's certainly provocative. So you can buy growing revenue with good trends, high,
Votes?
revenue, EBITDA, renewal trends. Yet you can buy them at a 75% discount to what these companies were purchased at through the first lien in the current environment. So that's the bull market, growing companies at a 75% discount. The bear market, or the bear thesis, is when you look historically of industries in transition, they've actually, you're only widened about 300 to 400 basis points, and you have another, call it
like
500
lower?
basis points when you look at media, if you look at retail, energy, when they've had corrections.
So which one are we in?
So we've been nibbling because we think that you're getting, for good the market's not
Nibbling
differentiating.
at software credits?
Yes. And we think the market's not differentiating. If you look at the equity markets, when companies post good results in software, they've been flying. If you look at the credit markets, when they've met or exceeded expectations, they've just stayed flat. And this is being down, call it 15, 20 points. Yet when companies miss, they're down a lot. So the market technicals are terrible. And usually that's a good time to be thinking about value, particularly for the good fundamentals.
Where else do you see opportunities being mispriced when you look at credit and equities?
So surprisingly, I'd say 2 themes. One would be some of the equities relative to debt We're seeing whether it's a Comcast versus an Altice. You look at Comcast, which we think has a better collection of assets, the stock of Comcast.
The stock.
And then if you look at the entire capital structure of Altice, it's trading in the mid-5s, whereas Comcast, a mid-5s of EBITDA. The balance sheet doesn't work. Whereas on Comcast, the balance sheet very much works. They have a lot of optionality, great assets.
Well,
and,
we're separated now, but
yes, I know.
yeah.
But
we know about those assets.
Yes,
yeah.
And a great collection of assets. And so we think that relationship is interesting in the public market equities.
So you guys actually do buy equities in your
absolutely have since
because
inception.
you see a mismatch between what the credit market is pricing and the equity.
And we'd say the same thing, for instance, MGM. The entire capital structure of MGM and Comcast could finance for less than 500 basis points in the debt markets. That's usually, if you believe in the viability of these industries and companies, usually been a good relationship, a healthy relationship. So we see Comcast is too large to take private, but I think the relationship and the value is clearly there. We look at an MGM, very good collection of assets compared to some of the more levered companies in the marketplace. We think that MGM stock is a better value, and you could finance the entire market cap in the debt markets. Keynova, which is a pharmaceutical company, also would be the same relationship. So we're seeing very good relationships between some growing equities that are generating healthy free cash flow relative to the debt. Another area is structured products, SRT, security risk transfer. This is a market which is actually wider than what it's been in the past year. We think the risk reward is very attractive.
What about how just rates are trading right now in general in terms of what they're pricing for Fed policy, for inflation, for the war?
We're somewhat agnostic because we don't know what's going to happen with the war, how long it's going to go on. It's certainly from a value standpoint, it's the longer this goes on, the more our thesis, which is we're in mid-cycle, valuations and spreads and yields are somewhat stretched. And historically, that's not a good environment for below investment grade investing. So our thesis is certainly the longer this war goes on, the more that thesis is playing out.
Well, Steve, it's great to get all the insight from you. So nibbling at software credits, and even got some stock picks in there as well.
Absolutely.
Steve Tananbaum, great to catch up and to see you here at Milken. Thank you.
It's great to be here.
From
Thanks.
GoldenTree. Carl, back over to you.